Hey guys, it's Kevin at NorthStarBadCharts.com, and I wanted to talk through gold and precious metals this morning, and just have a closer look at the gold chart and what we think it is telling us. So this is pretty typical of some of the analysis that you get at NorthStarBadCharts.com. So if you like what you see here, then by all means pay us a visit to the website and think about joining us. So moving swiftly on to share the screen, I'll stop my video here and start showing my computer screen. Here we go, screen number 3. There we go, screen sharing on. Okay, so this is the spot price of gold, and what I want to draw your attention to, well, a few things I want to draw your attention to really. First one is the vertical red lines that you can see going all the way back to the 1970s there, and those vertical red lines show the cyclical lows that have occurred. You see one here in 1976, another one in 1985, another one in 1993, 2001, 2008, 2015, and sometime around about now, although it could be between now and the early part of 2024. So we're looking for a 7 to 8.5 year major cyclical low. And one of the questions, I suppose, is whether the recent lows that we've just seen will be those major cyclical lows, or whether we have to endure further downside sometime over the next 12 to perhaps 18 months. In an attempt to try and address that question, I've also put the rate of change indicator on the bottom there. That's the black line that shows the 7-year rate of change, the 84-month rate of change. Why the 7-year rate of change? Well, because gold has a 7 to 8.5 year cycle, and so the rate of change over that cyclical length is likely to be important. And indeed, looking at the way the rate of change behaves in relation to its own 3-year moving average, and that's the green line at the bottom there, that's the three-year moving average. So you've got the 7-year rate of change with its 3-year moving average. So, okay, great, Kevin, how does that help us? Load of mumbo jumbo there, and what can we deduce from it? Well, what you can see is that when the black line, the 7-year rate of change, is above its 3-year moving average, the price of gold is in a strong uptrend. And when it broke down below the 3-year moving average here, it gave us a good warning that the price of gold was just about to pull back, and it fell all the way from whatever it was, $150 down to about $100. So there's about a 50% drop there. And then what happened? Well, the rate of change started to pick up, and it actually crossed the its own 3-year moving average, actually before you got a lot of the breakout signals down here, somewhere around about $130, $140. And then when the rate of change remained above the 3-year moving average, it tested it here and then moved up again. The strong gold bull market was in full force. And actually the breakdown here below the 3-year moving average was around about here. So as if anything, just slightly but before we got some of the other technical indications that gold was heading into a protracted downtrend. So somewhere around about 550 to actually probably a little bit higher, probably around about nearly $600, where we got that heads up from the rate of change indicator. And from that point onwards, aside from a small blip where it just briefly got above the 3-year rate of change here, it was in a protracted downtrend. And we had a very long period during the 1990s where the rate of change and the 3-year moving average kind of oscillated around each other for a very long period of time. It wasn't until 2001 that we started to make a move, and it very clearly got above the 3-year rate of change in about 2003 before we broke out from this arc here at somewhere around about $400. And then it trended above the rate, above its 3-year moving average. And even during the pullback in 2008, the 3-year moving average was not broken. So the rate of change did not break down below the 3-year moving average. Tested it on several occasions and then eventually broke down in 2012. And again, it gave us a nice early sort of exit signal, really, because it wasn't until later on when it broke some horizontal support and various other technical supports that it was very clear that gold was kind of in trouble and in a bear market. But the rate of change indicator gave us the early warning there. So it's clearly something going on with this 7-year rate of change and its 3-year moving average that warrants closer attention. And when you zoom right in on the current price action, and I'll do that first, we'll focus on the price action on the top. So what's happened is that we've seen this over 2 years sort of sideways, effectively sideways move, but more recently, a significant move to the downside that brought us down to around about $1,600. It was just a little bit above $1,600, I think. So that's a major move there with a lot of red monthly candles on the gold chart. In fact, it's very rare that you get 1, 2, 3, 4, 5, 6, 7 months in a row where the candles are red, meaning that the price of gold has closed the month lower than it started. 7 red monthly candles, and then we seem to have got a large green candle possibly developing here. So something sort of significant happening around about here. I've put this red line, vertical red line, on the month where we had the lowest reading, which was just a fraction below $1,615. But cast your eyes down to the bottom and you'll see something quite significant here. There obviously had been some concern that the 7-year rate of change would break below its 3-year moving average, and it hasn't done that. It's hit the 3-year moving average and it's bounced off it, and I think that could be very significant. If we're looking back at what happened at the breakdown here in 2012, just take a step back and look at the situation that we were in. The 7-year rate of change had been rising for year after year after year, and it was at a very high point and it broke down. Okay, now compare that and contrast that with where we are today. The 7-year rate of change is very low and has only recently broken out and moved above the 0 line. You see the dashed line here along the bottom here, that's the 0 line. So we've moved back into positive territory on the rate of change. So it's positive over a 7-year period. The rate of change is positive. And we bounced off the 3-year moving average. So one way or another, I think we are seeing as an important signal from the charts here. And you can see I've put on a support line that goes all the way back to 2001, and it bounces off this point here in 2018, the low in 2018, and continuing it on, it takes us to where we were over the last couple of months, and price is bouncing off that level. So there's multiple things on this chart that are sort of suggesting to me that there's a pretty high likelihood that the next low, when we get it, will be higher than the one that we've just seen. So in other words, higher than $1,615. I think it's what I said, wasn't it? So 1,614, 1,615, that kind of level. So yeah, the 3-year rate of change is rising. The 3-year moving average is rising. The 7-year rate of change has bounced off it, and we've bounced off a support line, and we're at the sort of timing period where you might possibly get the significant 7 to 8.5 year cycle low, although there is some question over whether we could see that over the next 12 to 18 months. So we're not quite there yet. And the other chart that is important with this one, and I'll just show you that as well to kind of round this video off. So here we are with the gold to SPX ratio, so this kind of completes the picture really, and it just reminds us to be a little bit cautious just for a little while longer, because we need the gold to SPX ratio to break out. If gold can start to outperform SPX, then that's likely, as in the past, to signal the start of a precious metals bull market. So there's no need to have any fear of missing out here, because it's very early days. You can see back in 1970-71, the gold to SPX ratio broke out, and then it sort of trended sideways for a little while before making its big moves. And the same sort of thing happened in 2002. Gold to SPX ratio broke out, had a little bit of a move, and then pulled back. And both gold and SPX in this period saw some gains. So the ratio trended sideways before gold really started to outperform the stock markets. So a breakout here could result in a little bit of a spike up and then a sort of sideways move as both gold and stock markets sort of make some gains, but then with gold significantly outperforming the stock market moving forwards. And some supporting evidence comes from the rate of change indicator as well at the bottom there. You can see each time in the past when this has happened, we've been in a situation very similar to the one that we're in at the moment, where if I zoom right in, you can see that the 7-year rate of change has just broken out above its 3-year moving average, which happened just before the gold to SPX ratio breakout in 2002 there, and the same thing back in the late 1960s and the early 1970s. So we're in a very similar position in many respects to both of those periods. So what we're looking for here is not just a little bit of a gold rally or a precious metals rally. We're looking at a multi-year precious metals bull market that is quite possibly going to take gold up between 500 and 700%. That's what happened last time. So, you know, a 500% move, you know, taking gold to, well, probably looking at $10,000 plus. And my sort of target is probably in the range $12,000 to $16,000, and that would be around about sort of 5 to 10 years from now. So it's not going to happen overnight. And you know, if you think gold at $10,000 or more is hard to believe, then just ask yourself, you know, would it have sounded hard to believe back in the early 2000s when gold was at $250 or $300? If I'd said to you it was going to move up to $2,000, you know, you'd have said I was crazy. So, you know, these sort of moves have happened in the past, and they will happen again. You know, of that we can be sure, and that's what these ratio charts are telling us. And as soon as the starting pistol is fired and we get the go signal from this breakout, then our members will be the first to know. So currently needing a move above about 0.48 on the ratio there, call it 0.5 just to be certain. We're currently sitting at 0.435, so we're some distance away from that, and for that reason we are not calling the start of the precious metals bull market yet. But what we are saying is that the ingredients are bubbling away nicely, and so this particular cake is cooking in the oven and waiting for the right sort of conditions to come together for the bake to complete. Waiting for the right conditions to trigger this huge multi-year bull market in precious metals. So that's basically what I wanted to say. I hope that has shed some light onto what we're thinking and how we're seeing the precious metals market at the moment. We're not there yet, but as I say, we are getting closer and closer as time goes by. That's it from me, Kevin at NorthstarBadCharts.com. Just a reminder that for the Black Friday weekend, we have a half price offer, and membership at Northstar Bad Charts will be half price for life for anybody that decides they'd like to join us whilst we have the Black Friday deal on. Okay, that's it from me for now, and wishing you a great end to the week and a great weekend. Bye-bye.